Okay, next up, we're going to jump ahead about a decade to Benchmark's next company and industry defining investment in Uber. Interestingly, the early 2000s were kind of a lull period for Benchmark. There weren't a lot of investments after Fund 1, which included eBay, like we talked about, that led to strong exits. Investments like OpenTable and Zillow had great exits. Investments like OpenTable and Zillow had great exits. Exits. Investments like OpenTable and Zillow had great exits for Benchmark in 2011, but there weren't too many other notable exits between 2002 and 2011 for Benchmark. Good thing that Benchmark had another one of the best investments of all time up their sleeves. As I mentioned, Benchmark just witnessed a big win with OpenTable. They roughly 30x that investment, which you can head to allthingsvc.blog. I'll link it in the show notes if you want to read more about OpenTable. I have more on my website, but we won't talk about it here in the podcast. But anyway, 30x that investment, and we're really starting to see the power of network effects. By now, they had witnessed it with eBay and had seen it with OpenTable, and former Benchmark partner Bill Gurley was starting to think about what other industries were prone to network effects. And so Gurley said, quote, "Having come out of OpenTable being successful, I was trying to think of other industries where if you put a network on top of it, it would absorb waste and make it more efficient and more usable." And the thesis of cars had come up. And we had met with several taxi startups where there were actually taxi startups before Uber, and we had quickly come to the conclusion that doing it on top of a taxi wasn't the right way to do it because prices were fixed. They were oligopolies, there's regulation, but if anyone did it on town cars, we would pay attention. So that was a thesis we had internally when they popped up. And so, just for those who don't know, before I keep going on about network effects is simply, does this business or does this product or does this service get better the more people use it? So eBay had network effects because as more sellers go on the platform to sell a new, unique good, more buyers would come on the platform, which gives the sellers more sales and gives the buyers more stuff they want. So that's a network effect. As more people come on the platform, it gets better and better. OpenTable, again, like I said, I talk about it on my website a little more, but again, connecting restaurants with eaters. And so as more restaurants went on the website, more potential diners went on the website to find new restaurants. And so more restaurants would want to join the website to connect with those diners. More diners would come on, so on and so forth. It's this loop that keeps going, and the website, the product, the service just improves as more people use it. So that's network effects. Extremely powerful, a core tenet of Benchmark. Really good investment if you can find a business that truly has network effects. And so short time before investing in Uber, Gurley had met with Taxi Magic, a leading rideshare company at the time, but he was not interested due to its work with the taxi industry rather than working to disrupt the taxi industry. Like he said in the quote we just said not too long ago, Gurley wanted something completely new from the taxi industry, free from regulation, free from oligopolies, so that it could truly be a free marketplace. Not free as in price, but free as in pure supply and demand in that marketplace. Eventually, Benchmark found Uber and quickly cold called the founders because this is what Gurley and Benchmark was looking for. So he quickly cold called the co-founders, Travis Kalanick and Garrett Camp, to meet. But Benchmark passed on the seed round because Neither of the co-founders wanted to be CEO, and so Gurley felt that they weren't totally all in, despite being great entrepreneurs themselves. I mean, Kalanick had founded two companies, sold one of them, Red Swoosh, and Garrett Camp had founded and sold his company StumbleUpon quite successfully a few years before Uber. And so, they were proud of Uber and thought it was a really cool idea and had this big vision for it and invested their own money in it, but they just weren't fully committed to running it. They were trying to find an outside CEO. And so that's just definitely a red flag to an investor. And so another benchmark partner, Matt Kohler, who we mentioned earlier, actually, funny enough, became the number one rider of Uber over the next few months. He took it multiple times a week. He loved the product. And Benchmark continued to monitor Uber heavily and keep in touch with the founders and see how things were progressing. And so only 4 months after raising their seed round, Uber announced they would be raising a Series A round. They were ready for the next step. And by now, Travis Kalanick had actually become the CEO, so stepped in full time, and even Garrett Camp was more involved. And so the one question that gave Benchmark hesitation around doing the deal at the seed time was now answered and put to rest. They had their CEO. Travis Kalanick was the CEO, founder CEO, ready to go. I'm sorry that rhymed. And so Benchmark aggressively pursued the deal. And so there are two funny stories that show actually just how aggressive Benchmark pursued the deal with Uber. And so first, they knew Travis was pitching to Sequoia the same day he was pitching to Benchmark. Actually, he was pitching to Sequoia right before he was going to go pitch to Benchmark. I don't know how the Benchmark partners found out about that, but they knew. Anyway, Kalanick, obviously, had taken an Uber to the Sequoia office and asked the driver to wait outside, which, should be fine because no one in Mountain View would likely call an Uber in 2011. But the partners at Benchmark, to mess with Kalanick, had called that same Uber to the Benchmark office, leaving Kalanick stranded and having to actually run to the Benchmark office from Sequoia to deliver his pitch. Apparently, he showed up all disheveled and sweaty, which is just funny prank by the Benchmark partners. As a little, that's what you get for going to Sequoia. Luckily for Travis Kalanick, every VC firm is basically neighbors, so I'm sure it wasn't a huge run. Anyway, the second story, which is also really funny, is after Kalanick pitched the Benchmark team, they put him in another room at the office and told the receptionist to not let Travis Kalanick leave until the partners were done creating the terms of the investment. So they had the meeting, they said thank you, locked him in a room, and then brought him back a few minutes later after they had discussed and came to terms with what they wanted in the deal, and they were ready to finalize it with Travis. I mean, I'm sure they already basically had one written up. They just needed that official meeting and confirmation, basically. And so Travis Kalanick is known for being incredibly aggressive. And so he loved the pursuit by Benchmark. He tells these stories actually in an interview with a big smile because he and Benchmark both shared that passion for making Uber a world-changing company. And so he's asked in that same interview why he went with Benchmark. And he simply says, no hesitation, no elaboration. They're the best. It's not even a close call. And so great founder VC fit right there. In 2011, Travis is happy, Benchmark's happy, they're on the same page. Obviously, this wouldn't last long term. For those who don't know, just search Travis Kalanick, Benchmark, Uber, board, nightmare. And you can read it for yourselves. We don't have time to get into that today. But anyway, at the time in 2011, great founder VC fit. So why was Kalanick becoming CEO full-time the missing piece for Benchmark to invest? Well, for one, he had experience running a company, like we talked about. But two, and more importantly, Travis was unbelievably driven to make Uber a successful company. Sorry for using the word driven for Uber. It's just first thing that came to my mind. But anyway, and so that's a really important trait that Benchmark looks for. They look for founders who are deeply motivated by the mission of the business. And so another quote from current partner Sarah Tavel in what Benchmark looks for founders, she says, quote, "This stuff is really freaking hard, like building a company that endures. It's a relentless pursuit of excellence. You have to be so vulnerable and admit how little you know because you're constantly in the biggest job you've ever had, like you're constantly growing, being challenged. All the things that you don't know or all the mistakes you're making, it's just part of being a founder, being a CEO in particular. You have to have a drive that's going to get you through that mission. It's one of the most important drives. Just feeling so committed to the reason why you started the company in the first place and what your customer needs from you. But there's another thing that I think creates that overdrive, and it's that desire to win that pushes you. Now, after reading a lot about Travis Kalanick, he was certainly driven to make Uber a success. I said driven again. He was certainly motivated to make Uber a success. But I think it was more so because he was such a competitive and vindictive person rather than some virtuous motivation. Um, he's certainly the type of person that when someone tells him he can't do something, he immediately tries to figure out how to do it in spite of that person to prove that Travis can, in fact, do anything and no one can tell him he can't. And so this is great because there are few of, if any, software companies that were harder to build than Uber because every city they launched in was met with intense scrutiny by the taxi industry and by the mayor's office and just any type of regulatory committee that had a bone to pick with Uber. And so Uber had to fight so hard and never take no for an answer. And while being vindictive typically isn't a virtuous trait, in challenging startups like Uber, it's almost a necessary evil. Anyway, Benchmark moved so fast on this investment because this deal was years in the making. Like we said with Bill Gurley in that quote back in 2009, they had already built up this thesis that many marketplaces with network effects were left to be created. eBay built the one for collectibles, and OpenTable built the one for restaurants. So they were constantly thinking, where else can you put a marketplace? And so Gurley had ride sharing as an idea and was actively looking for the right company. And so once they found Uber, they already knew about the potential of the industry. All they had to do was be sold on the team to do it. And sold they were. And former Benchmark partner Bill Gurley, who we've talked about many times, has a quote when figuring out what industries can become online marketplaces when he says, quote, "Certain businesses are prone to monogamy. So babysitters are prone to monogamy. Haircutters, if you find a good one, prone to monogamy. Doctors, dentists. If things are succeeding, you're not changing, and those businesses are tougher for marketplaces. Restaurants, you're prone to promiscuity. You go to your favorites, but you want to try new ones constantly. So that's a very different dynamic for a marketplace. And so I'd assume, unless you're filthy rich, you don't have a personal driver. So you don't care who drives you around. You just want to get to your destination quickly and at a fair price. So, like Gurley described with restaurants, ride sharing is also prone to promiscuity. So at the time Benchmark invested, Uber was growing 25% month over month. Maybe not eBay growth rate, but late 90s don't count with the internet and tech bubble. So 25% month over month growth rate, fantastic. And they were in 8 cities. And while I don't know for sure, based on their growth rate and working backwards, it seems like they had somewhere between 50 to 100 cars within or on the Uber platform in San Francisco when Benchmark invested. So I'd assume they had roughly 50 or so cars in the rest of the 7 cities. So they had maybe 500 or so cars, serving customers. Again, I talked kind of fast, so let me reiterate. When Benchmark invested in Uber, they probably had 500 cars total on the platform in 8 cities. That's quite different from Uber today. I mean, if you go outside on a busy street corner in a city, you'll probably see 500 Ubers in an hour. And in fact, I actually got some numbers because, Benchmark had to have a vision to see where Uber could be. I mean, to see it grow from 500 drivers to today, which is 5.4 million drivers, doing about 250 rides a second. So 500 drivers completed a ride every 2 seconds. And 12 years ago, there were 500 drivers total. I mean, that's crazy. And it's so crazy that it's actually even unbelievable to Bill Gurley, who led the investment and sat on the board for many years, which we'll talk more about later. But also, even the founders didn't see that type of growth or market expansion coming. I mean, in their first pitch deck, which I can link in the show notes, and I'll have a link to our website to look at it as well, that they used in their seed round. And I'd assume many of those slides they also used in their A round when they raised just a few months later from Benchmark. They said how their overall market, their total addressable market, was $4.2 billion and just growing a few percentage points a year because this was calculated based on the taxi and limousine service markets, which they felt Uber was an alternative to. And another slide, which is also so funny, along the same vein, is one of their final slides in which they say the best case scenario for Uber is over $1 billion in yearly revenue. And so, to explain just how short sighted the Uber team was, and I'd assume Benchmark, and I'd assume everyone else in the world who didn't see this type of market expansion coming, Uber's revenue in 2022 was $32 billion. So about 32 times their quote best case scenario and yearly revenue number. Insane. And maybe even crazier, their revenue itself in 2022 was 7.5 times higher than their projected $4.2 billion total addressable market just 12 years prior. And so that is an insane amount of market creation by Uber that maybe only Airbnb rivals, but I highly doubt even Airbnb didn't 7.5 times the hotel industry market. I mean, that is just ridiculous. And so I'm going to go on a bit of a tangent from what we typically talk about, but one I think is really important and also just incredibly interesting that has to do with this market expansion idea that we just gave the ridiculous numbers for. And so, while we typically talk about why investors invested in the companies they did at the time of the investment, this has to do with market forecasting, which is important to think about, and market sizing and everything when you think about making an investment. I mean, you have to think that this market has room to grow. And so I read this great essay that Bill Gurley wrote in 2014 about Uber. I'll link it in the show notes. I highly recommend you read the whole essay because it is fantastic. But he talks about why Uber's market has expanded so much and why it has so much more room to grow. And so before I get into the piece, Benchmark invested in Uber in 2011 at about, I'm going to talk about this later, I think it was a $60 or $70 million valuation. In 2014, 3 years later, when Bill Gurley wrote this piece, Uber was valued at $17 billion just 3 years later. Crazy. Anyway, let's get into the essay. And so, again, as an investor, you should be thinking about market expansion. As a founder, you should be thinking about market expansion. Like we talked about with the Sequoia episode last week, the Jim Getz quote about having a good TAM story, a good total addressable market story, is very important, and showing how your product and service can expand that TAM by unlocking something completely new that the investor had never heard before or couldn't imagine before meeting with you as a founder, will almost guarantee you an investment if your claim is reasonable and if that target is attainable in some regard, if you can actually expand that market. And so this is kind of a thought exercise in that regard, with the help of hindsight. So bottom line, it relates. Also, I think it's really cool, and it's my podcast, so what I say goes. Anyway, so first in the essay, Gurley cites a few reasons why Ubers are better than taxis. Most of these points, I'd assume, they knew at the time they made the investment, or at least knew it could come to this at the time they made the investment. So I'll summarize them here real quick. So number one was faster pickup times. An Uber in a city typically takes around 5 minutes, maybe more, depending on the time, but around 5 minutes. And you have a live tracker to see how far away your car is, allowing you to plan and allocate time as you wish rather than just waiting outside looking for a cab that will come whenever you get lucky. And so number two is coverage density. Uber drivers are based anywhere and everywhere. So it's typically easier to get an Uber in a more suburban area than a taxi. And it's especially easier in most cities to get an Uber than a taxi. Number three is payment. You never think about payment when riding with Uber because your card is just already on file and the payment is automatic. You can pay for 1,000 rides just by taking a few minutes to upload your card before your first ride. So eliminates so much friction and wasted time in that regard. Number four is civility. The dual rating system ensures that higher rated drivers are rewarded with more rides, and the higher rated passengers are rewarded with better drivers and faster pickup times. So there's an incentive alignment there to just be a good person. And number five, similar to civility, is trust and safety. There's a record of every ride ever taken, and Uber can track, find, and monitor every ride to ensure the ultimate safety for the driver and the passenger. It's all tracked. They're kind of like they're watching over you. A nice watchful eye. Number six, it's cheaper. Dramatically lower prices than taxis because as Uber scales, it can pay its drivers less because they're getting more rides. So their per hour rate remains the same, even though prices are getting cheaper. So this in turn has no effect on drivers, but a massive positive effect for riders. And so lastly, and most importantly, like all companies with network effects, it's scalable. And so since it's scalable, all of the 6 points we just mentioned improve as more people use the service. Prices get cheaper, pickup times get faster, higher rated drivers and higher rated users take more rides, and the platform becomes more secure. It's just a true scalable marketplace with network effect. And so, you probably thought, yeah, that makes sense. I already knew all those things about Uber. In 2014, this was a little more interesting. Now it's pretty well known. But the next part about Gurley's essay is the part I find really interesting and where this conversation about market expansion really comes into play. After all, there's a reason Uber 7.5x'd their TAM in 12 years from their initial projections, which is, again, unfathomable. So why did that happen? Had to happen somehow. And so this is what Gurley talks about as Uber became an alternative to car ownership. So there are a few reasons for this. First was this trend, which is continuing today, that just fewer people are driving cars. In 2008, which Gurley cites in his essay, less than half of eligible drivers aged 19 or younger had a driver's license, down from nearly two-thirds of eligible drivers who had a driver's license just 10 years before in 1998. And number two, young Americans increasingly prefer urban settings rather than suburban settings where more cars are typically needed. And so, therefore, people are spending more time and money on public transportation, such as subways or Ubers. And Uber is certainly a cheaper and just easier means of traveling within the density of a city. I mean, I can personally tell you in DC, I have to walk 15 minutes just to the parking garage where I have to store my car that I pay an absurd amount of money for. So, yeah, having a car in the city, not fun. And so I have this chart in the essay. Again, if you go to All Things VC on Substack, you can read it and look at these pictures as I describe them. But it shows this steep incline of populations in the United States getting more urban. And, in 1850, does that really count? It was like 10%, maybe 5%. But in 2010, it's all the way up to 80% of the US population living in urban settings. I assume in 2023, it's probably more like 85% or something. I mean, actually, maybe it went down after COVID. Should look into that. But regardless, around 80%, really high. And so that's the first one, just fewer people driving cars in general. This trend of young people not wanting to drive and young people moving to cities, more people in general moving to cities. And so the second point that Gurley talks about is that car ownership is really expensive and comes with its inconveniences. It's inconveniences like, if you drive somewhere, you can't have a spontaneous drink with friends or work colleagues because you have to drive home afterwards and you don't want your boss looking at you funny. And it's illegal, but you know what I mean. And number two, just the unknown amount of time it takes to park your car in a densely populated area like downtown in a city can just be extremely frustrating and just wasting precious time that you have for whatever you're trying to do. And again, it's expensive. More expensive than I knew, actually. Gurley cites a 2014 report, which, if anything, is more expensive now, that states the average cost of owning a car based on gasoline, insurance, raw materials, servicing and repairs, and just the actual useful life of that car expensed over the years is about $9,000 a year. So if you live in a city and want to own a car, you'd have to spend $9,000 a year to deal with all those inconveniences I listed above. And so as more people move to cities, likely fewer people want to buy a car. And actually, one quick point that Gurley didn't mention, I don't know if this was very apparent at the time, but now I've recognized this is pretty apparent, is that people today are taking Uber rides as an employee perk. Like many people in pretty prestigious jobs in downtown areas can take Ubers to their office, which is fully expensed by the company. Again, major market expansion by Uber. I'm sure Uber didn't know, Morgan Stanley was going to be a customer for 10,000 of their employees. I mean, that's crazy. Daily. Crazy. Anyway, the last point that I thought was craziest out of all these things I read, I've said the word crazy a lot, but this essay is just really interesting. And so the last point Gurley makes actually in a later interview, not in this essay. What's crazy about this is that less car ownership, benefits more people than just not having to pay, $9,000 a year out of their pocket and dealing with all the inconveniences of driving and parking a car within a city. It also decreases housing costs. And so Gurley cites that, for example, in 2016, Houston had 4.5 parking spots per car. People don't need that many cars anymore. That trend is declining. More people are owning less cars. So if you decrease that number to 2.5, even 3 parking spots per person, there can be way more housing units available for people, therefore drastically lowering the price of housing in a major city. And so Uber, I would argue, in a way, is actually a pretty virtuous business, which is pretty funny. I mean, Uber's lowering housing costs. What other companies doing that indirectly? I mean, that's crazy. Anyway, I could go on forever because this is just so fascinating. I'll stop here, but I highly recommend you go check out that essay and read the whole thing. Probably takes you 15, 20 minutes. Really interesting. So, back to 2011. When Benchmark led the Series A into Uber, they invested $11.5 million for about a 19% stake in Uber. The exact amount Benchmark invested in the lifetime of Uber is unknown. However, they don't have growth funds, so they can't do much follow on investing. They were diluted down to 11% at the IPO since Uber raised another $22 billion of private venture capital before their IPO, which is just insane. I am pretty confident that's the most a company's ever raised. And so, therefore, I'm going to assume Benchmark invested about $25 million. They did a little bit of follow on as they could. But again, they don't have huge funds, so they can't invest that much follow on money, much like a multi-billion-dollar Sequoia fund can with Airbnb. So this number could be higher. I doubt it. Let's just say they invested $25 million total into Uber. Could also be less, 15 million. I don't know. Let's say 25 million. How much they invested doesn't really matter though, because their stake in Uber at the IPO was worth about $9 billion. And before the IPO, they sold about $900,000 worth of Uber stock to SoftBank during a late venture round. So they made just under $10 billion on this investment, on likely just $25 million of invested capital. Sorry if you couldn't hear me from laughing. They made just under $10 billion on $25 million of invested capital. If you thought eBay was crazy, here comes Uber. And so let's look at some more numbers because, again, it's just so crazy not to. The IRR is 111% compared to eBay's 2000 something. Maybe not as impressive, but from a clear mind, 111% IRR, crazy. And the multiple on that investment is 396x. Crazy. Multiplying 25 million 396 times, ending up with $10 billion. So yeah, Uber was a good investment. I'm sorry. I meant to say that Uber was the greatest investment of all time. Maybe behind eBay, who we talked about earlier. You could kind of argue Airbnb. I wouldn't. I think it's either eBay or Uber. Crazy, crazy investments by Benchmark Capital. Like I said, they're considered one of the best for a reason.